Good morning, everybody. Thank you very much, Cafe Mutual, for having me here. Normally, in situations like this, I like to give a prepared speech, particularly since I wear the hat of a regulator nowadays. But honestly, I've not had the time to be able to put together something, so I'm going to trust my instincts and speak extempore at this point in time. You know, as I was reflecting on the topic which was just introduced, I realized this is largely a group of people who are interested in the alternate space. Many years ago when I joined a foreign bank, I was given media training. And the media training, one of the first things I learned, which still stuck to my mind after all these years, was whatever be the question from the media, you give the answer you want to give. So it's even better if you don't listen to the question at all. Just say what you have to say. So I'm going to deviate a lot from the broad topic which has been given to me, which is about alternatives. What I do promise you is that I will try and weave in alternates everywhere possible. But what I wanted to do was the following. Give a broad picture of the way we in SEBI look at the investment scheme space, the whole space of actually having these investment schemes, whether across AIFs, whether across PMS, whether across mutual funds, which frankly has had a fantastic run over the last few years. I think we'll all agree on that. It's had a fantastic run. Now, I want to reflect on, while we have done extremely well over the years, and we will all agree that the future is also extremely high in terms of potential. There are some areas where I think we should reflect, both as regulators as well as industry participants. So I'm going to be a bit of a wet blanket and reflect on some of the things that on our mind. I'm going to then try and end on a positive note in terms of reflecting on or laying forward what's in our mind in terms of the way forward, where I think there's a lot of good things of potential. So let me start off with the broad good news so far, and it's been a fantastic journey, and each of you, by the way, deserve to take a bow for this. There's no doubt that the growth in the last 5 years or so has been tremendous. Look at AIFs, for instance, right? Currently, as of March 2024, and the June data will come out very shortly. I don't want to give out the June data because it's not public as yet. But as of March 2024, we had commitments into AIFs across all categories, crossing 11.4 lakh crores. We have investments of about 4.07, let's call it 4.1 lakh crores already done. And this number, by the way, is nearly 4 times what it was as of March 2019. So it's been a tremendous growth, purely in both in terms of commitments and, more importantly, in terms of investments as well. That's really, really good. Likewise, if I look at the PMS numbers, right, and if I remove the EPF4, the pension fund numbers, which tends to skew the numbers and make it look very big, PMS numbers, as I see it, as of June 2024, have now crossed 10 lakh crores. You know, as of 5 years ago, June 2019, it was about 4.6 lakh crores. So again, tremendous growth even in the PMS industry. Now, there's no point repeating the numbers for mutual funds. You all know these numbers very well. But if I recollect, it was about 25, 26 lakh crores, I think 25.5 lakh crores as of June, July 2019. Today, it's nearly 65 lakh crores as of June 2024. So it's been a huge growth. And even in terms of numbers, obviously mutual fund kind of dominates there. It was about 2.2 crore unique mutual fund investors as of 2020 March or so. Today, that number is pushing close to 5 crore unique investors. So it's a huge, fantastic story. And frankly, that's been very, very positive. In fact, there are some numbers that we like to track. You know, between fiscal year 16 and fiscal year 21, on average, we used to have something like 40,000 crores of rupees per year coming into the secondary market net across developmental institutions, DIIs, across mutual funds, and across individuals. So all the people and all the institutions which bring in savings into the capital market ecosystem were roughly bringing in 40,000 crores per year between FY16 and FY21. The last 3 years from FY22, 23, 24, that number has gone up to 3.1 lakh crores each year. Almost 8 times. I'm talking only about secondary market. We'll come to the primary market a little later. But it's been a big harnessing of Indian savings thanks to all these investment schemes, not just in SEBI, but outside as well, including insurance companies and so on and so forth, which has brought in a tremendous amount of interest, and not just financialization of savings, but also financialization of savings into capital markets over the last few years. And the results are there for all to see. So if you actually look at our returns in the markets, we've had 15% returns compounded annual growth rate in dollar terms over the last 5 years. In fact, we are probably amongst the only major markets in the world to offer these kind of returns. By the way, not just returns. If you look at our actual realized volatility as well, in terms of whichever measure you take, including things like log normal, standard deviation of returns, etc., it's actually amongst the lowest across all developed markets and major markets. So it's been a fantastic run, and it's clearly a combination of things like good macros, excellent earnings, digitization, formalization, the big companies doing well, even the mid companies doing well, and of course, all of this harnessing of savings coming into the investment and capital market ecosystem. So it's a great, great story. Now I'm going to offer a few wet blankets. As a regulator, my job is to worry. And later on, I'm going to argue that it's your job to worry as well, not just the regulator. So there's this old saying which I think was said by Kabir Das. My Hindi is not great, so pardon me. But there is this lovely doha of Kabir Das, which goes, and you would all heard of this. Dukh mein sumiran sab kare, sukh mein kare na koe. Jo sukh mein sumiran kare, to dukh kahe ko hoye. So the gist, I'm going to completely, change the context in which Sant Kabir Das said that doha and convert it into our capital markets ecosystem. This is a nuance to what Warren Buffett in modern days says, right? Be fearful when everyone is greedy, and be greedy when everyone is fearful. We are going through very good times, make no mistake about it. And the immense, the participation that we are seeing from the folks on the ground gives us confidence that this can really continue for a while. But this is also the time to reflect on both opportunities as well as challenges as we go forward. Opportunities are immense. While I talked about nearly 5 crore unique investors in mutual funds, and NSE recently announced more than 10 crore unique investors in their stock markets, the total number of PAN-Aadhaar linked numbers are about 55 crore at this point in time. So you can argue that the gap is quite large in terms of where we can really go. So what are the issues which I think is worth looking at? Remember, I talked about money coming into secondary markets. So we actually did this analysis for the last fiscal year, FY24. What we found was across primary and secondary, if I look at all the DII money, the mutual fund money, the individual money coming into both primary markets and secondary markets, that was about 3.6 lakh crores. So that's the amount of money which has been mobilized by everybody into both primary markets and secondary markets. The actual primary issuance, and I'm including everything, I'm including IPOs, I'm even including things like QIPs, preferential allotments, even OFSs, which frankly you can argue is not really a primary, but even if I include OFS and rights issues, that number is less than 2 lakh crores. It's about 1.9 odd lakh crores. Now, we will always have a gap. We will never have a perfect situation where supply is exactly equal to demand. But this trend of mismatch between the amount demanded and the actual amount which is being supplied has been growing over time. Now, one thing we have to reflect on is, does this lead to a situation where you have more asset price inflation? rather than capital formation. Now, ideally, what you would like is just as demand for paper and securities increases, supply should increase as well. And as supply increases, people raise capital, people deploy that capital, people create businesses, people create jobs, which creates savings, which creates more demand for paper, and then it becomes a nice virtuous cycle. You can't always expect this perfect meeting of demand and supply, but eventually you would like to see it catch up. At this point of time, I think it appears that the demand for paper is much more than the supply of paper. Now, one reflection, again, related to this, but not necessarily causal. What we've seen is that over 40% of the mid-cap and small-cap stocks have gone up in prices more than 5 times over the last 5 years. I repeat that. 40% of all mid-cap, small-cap, micro-cap stocks have gone up 5x. If it was 100, it's now quoting at 500 plus. And that's 40% of that universe over the last 5 years. Now, any number of reasons, completely perfectly valid reasons can be given to justify such valuations. Don't get me wrong. I'm not saying these valuations are wrong. A regulator's role is not to talk about specific valuations. I'm simply saying that it's worth reflecting as to whether this mismatch that is apparent in terms of demand and supply needs to be addressed in some form or the other. And this is where, we have a very large fiduciary responsibility. We, not just as in SEBI, I'm saying this, everybody in this particular room, in terms of being able to understand these risks and being able to reflect upon them, debate upon them, and make sure our investor base is also completely cognizant of the risks, if any. Now, I'll give you an example of this particular point about risks. Some time back, we asked the mutual funds to conduct stress tests, right? On your portfolios, do a stress test to figure out, how many days would it take to liquidate X percentage of your portfolio, et cetera, et cetera. Now, the results that came out were frankly idiosyncratic results for that particular scheme, for that particular fund house. That was not a system-wide stress test. It did not tell you if across the ecosystem, 10% of all mid-cap schemes, small-cap schemes saw withdrawal, what would happen? Now, we've done that analysis in SEBI. It will become public soon. I don't want to preempt the numbers. It's going through a check. We always do a peer review before we come out. There are both good news and bad news there in general, though, as far as what we can see. First, the good news. The stress test for industry-wide, you might find this surprising, indicate the stress has not gone up dramatically between March 2020 and March 2024. So the number of days it takes to liquidate 5, 10, 15, 20% of the portfolio has not really changed. That's the good news. What's the iffy news? Reality is the average daily traded volumes have also gone up quite sharply between March 2020 and now. Now, we saw these volumes going up because individuals, mutual funds, everybody was demanding paper. Therefore, the market was very happy to give that additional trading volumes and supply. What we don't know is if you actually have a withdrawal and a stress, will the volumes actually hold up? Will the market be as welcoming of demand for paper as it has been, for supply of paper, as it has been for demand of paper? In fact, if I look at the numbers as of March 2023, when the delivery volumes were not that great, you actually see the stress having gone up. Now, these are numbers we have to, what I would strongly encourage the industry as a whole to do, not just the mutual fund industry, but others as well. Do these kind of analysis, do it with credibility and make them public. It's always good to have open discussions about possible risks. We shouldn't overread stress tests, but at the same time, we should be looking at them and making sure it's there in our radar somewhere. The other thing which I'll point in this particular, while we're having this discussion about stress tests, etc., I think as an ecosystem, we've got to find better ways of communicating the risk involved in investments to our investors. We have this, for mutual funds, we have this riskometer, which gives you some numbers. It's a huge improvement over what it used to be in the past. But reality is, you can't have every single equity scheme and credit scheme all in one bucket of high risk. There is obviously a difference in the risk of depending on the actual portfolio you're holding. I would argue that depending on the actual realized volatility in a particular portfolio, maybe the implied volatility from F&O markets, and what the stress tests show in terms of the liquidity of that particular scheme, a combination of all of this can be used to develop better metrics of what the actual risk in an investment is. You have to remember, a lot of people who have entered into markets this time haven't seen down cycles. They've all got used to seeing only up and up and up. Of course, we see up, a periodic up and down, but it's by and large been very, very smooth. We've got to make sure people understand the risks and are therefore investing responsibly. Much as we, want people to come in and participate in capital formation, they have to come in with their eyes completely open and completely aware of the risks. Otherwise, we risk actually destroying capital formation if, God forbid, something wrong was to happen, where everybody then starts to get a shock. So, in the interest of time, I'm going to skip a few things, but very broadly, based on all that we've discussed so far, whether it is AIFs, whether it is PMS, whether it is mutual funds, I think we have to spend a lot of time on ensuring suitability and appropriateness of whatever it is that we show our customers. Do people really understand the risks that accompany the investments? Unfortunately, maybe fortunately, we have an ecosystem which is dominated by distributors who are paid by the manufacturer rather than by the investor. Now, even if you have the best of distributors with the best of client interests at heart, that fear or perception will always remain that are you really having the best interest of your customer at heart? Now, this, as producers and distributors, we've got to work on collectively, on ensuring there are checks and balances, that such questions remain exceptions rather than the rule. That we ensure that suitability and appropriateness for whatever we are selling, whether it's AIFs or mutual funds, is absolutely at the core of whatever we do. It's imperative to ensure that we don't kill this golden goose which is laying these golden eggs, to ensure it sustains and we don't kind of, kill it in one go. I'm going to sort of skip forward to the happier part now. On AIFs particularly, and I look after AIFs, my colleague Amarjeet looks at mutual funds and PMSS. There's a lot that we have done so far in terms of trying to make the investment process easier. I know we get a lot of flack sometimes saying you guys over-regulate AIFs and what's wrong with you and why do you always come and talk negative about AIFs? So the reality is the following. We did see several instances in the past where, unfortunately, AIFs were being misused as structures to circumvent existing financial sector regulations. I've spoken about this in the past, okay? And I don't want to beat that drum again. But what we have tried to do is make sure we don't throw the baby out with the bathwater in responding to the situation. What we've tried to do is to isolate these exceptions and make sure that we are doing what can be done to further the good part of the ecosystem. So we don't want bad things to happen. That's definitely our objective. At the same time, we don't want to come in the way of good things happening. And if possible, we want to actually sponsor good things happening. So one big thing that we did to try and achieve this balance is we've come out with this framework which requires a code of conduct such that fund managers ensure that there is no circumvention using their particular funds. And the do's and don'ts that accompany that code of conduct are being written by the fund managers themselves. So we are requiring the fund managers and their associations to come out with the draft, do's and don'ts, of course in conjunction with us, such that the good guys will have no problem complying with them. The bad guys might say they have complied but not actually comply, but at least it will give us a hook to go back and do some enforcement in case there's something wrong goes on. I think that particular process has really helped us at least remove this overhang of all the wrongdoings and then focus on capital formation. One big positive which I think has happened over the last 2 years, remember in the old days, if an AIF hit the end of the tenor, you had nowhere to go. You could do nothing. Now we have allowed, initially we allowed for a liquidation scheme, now we have allowed for a dissolution period. In the same fund itself, with the consent of the investors, you can continue to exist with the fund, thereby giving some breather for people who are kind of stuck with investments which can't be sold at that point in time. We've extended this to venture capital funds as well. A lot of old VCFs were stuck, and in fact, we're getting regulatory action because they were unable to sell their investments. Again, in that case, what we've done is you can convert yourself into a AIF under very, very easy conditions, and then go into a dissolution period, legalize yourself, and then move on and take care of your investors. Likewise, we've allowed the pledging of equity that AIF holds in an investee company, as long as it's an infrastructure, for raising of debt in that investee company. Now, in the past, we had concerns about doing this because of the fear that this might be used to build leverage in the ecosystem. But because we have checks and balances through the code of conduct, we are now comfortable doing this. This has now been allowed. Likewise, simple things like every change in the PPM does not require a merchant banker to get involved and you to pay some extra cost. We've said there are a whole bunch of changes, such as supposing we come out of the circular and you're simply incorporating that, make the change, no need to involve a merchant banker, we trust you. We've also allowed and formalized the allowing of AIFs to actually undertake some amount of limited leverage in the form of borrowings to fund for mismatches between when the people actually pay the money during the drawdowns. We've allowed for, and we formalized this, saying it's okay. I mean, if you have 1 month delay, go ahead and borrow the money. So there are plenty of other things. For instance, on accredited investors, I don't know how many of you know this, we've really simplified the process. Earlier, the agencies which gave the certification of AI or accredited investor would look at your CDD, KYC, PMLA, all of that. We've said not required. Anyway, the intermediary, in this case the AIF, is doing all that. All you have to do is to verify whether this person understands the business or is financially capable enough to be able to take on this risk. That's it. That's your limited remit. I think the process has improved dramatically as a result. Now, going forward, at least for AIFs, what are the things which I see on the anvil? One big thing that we are really proud of in SEBI, we are now trying to see how we can automate the process of giving these approvals for PPMs and first fund, et cetera, By the way, as of March 2024, we didn't have a single application or approval for a first fund which was more than 1 month old. Our aging as of December 2022 went into beyond 6 months as well. As of March 2024, it was not a single case pending beyond 1 month. Bad news, it's again slipping into 2 and 3 months, to be honest. But we are doing something about it. So you know what we're doing about it? We are actually using large language models to go through the PPMs to do 90% of the work which otherwise an officer would have to do in terms of going through the PPMs. And these are 300, 400 page documents, as you know, right? And we know that we can't simply use ChatGPT 4.0 for this because it's a public tool which is available to everybody. We know these are private documents. So we actually have our own on-premises licensed version of an LLM, which is only used by us, which stores this data, where we can actually do this processing on an ongoing basis. It's still being trained, and we are trying to do the training alongside the actual processing so that it becomes faster. But this will really ease the whole process of turning around on PPM approvals, etc. Very quickly on new asset class, that's a bit of a point of contention, which is, what are you guys thinking about this? Why are you coming with this higher risk asset class and mutual funds? Look, the broad regulatory intent is very clear. You've seen us talking about futures and options. You've seen us talking about possibility of expiry date trading in index options, only that, not the entire F&O market, but only the trading of options, index options on expiry day, starting to resemble a casino slot machine, right? We don't want retail folks to squander their money on that and increase systemic risk at the same time. We've done that study of Jan 2023 on F&O. It's being renewed. We've done the study as of or rather March 2024 as well. Again, I won't come out with the results right now. It's going through a process of validation of the numbers. But the broad sense has not changed. If it was 89% that time, it's probably 91% now. Nothing has changed in terms of the number of people making losses. So our intent is we would much rather have professional managers and the professional ecosystem represented here manage risk for folks rather than them doing it themselves. So what we are trying to do is, whether it is this new asset class, whether it is PMS, whether it is AIFs, the schemes and the vehicles that we understand and we regulate and we are starting to trust, we would much rather the risk comes there rather than stay with an individual who doesn't understand the risks. If you're an individual who completely understands the risk, no problem. But for the others, we want avenues. And we are trying to give a graded approach of different types of schemes for different types of people. So that's the real intent here. This doesn't mean we are trying to kill any asset class, neither PMS nor AIFs. We're not doing any of that. We are simply saying we are giving more avenues for higher risk. We will make sure that the gradation of risk is kind of continuous as much as possible. Do give in your comments on that scheme anyway. We're also trying to ensure that valuation across all entities regulated by SEBI should be uniform, or at least the principle should be uniform. We've seen ridiculous situations where A buys something from B, A also books a profit, B also books a profit, because the way in which they value the same instrument is different. So we don't want that within the SEBI world at least. Some consistency is required. We are not for a minute saying what is right. You guys decide in the industry what is the best way of doing the valuation in a manner which is consistent, and let's follow that. Similarly, we will allow tranching in AIFs. So, we stopped tranching because we saw a lot of AIFs actually misuse that for doing evergreening of loans. But now that we have that check and balance, which I talked about earlier through the code of conduct, we are very happy to allow, with these checks and balances, tranching, particularly for government-owned entities, for supras, for multilateral organizations, and so on and so forth. So all of these are there in the anvil. Now, I'm going to close. I know I'm already out of time, but I'm going to close with a couple of suggestions for the industry and for ourselves. First request, please be trusted advisors to the ecosystem. I know that we face the criticism that we are too regulatory in our approach and not enough, thinking about capital formation. Our criticism is the reverse, that you seem to be too business-oriented and not enough on thinking about the ecosystem as a whole in the long term. An example, there are egregious things going wrong in some parts of the AIFs, like I mentioned. When I talked about this to the seniors in the AIF ecosystem, especially on a one-on-one basis, and many of them are friends, they said, हाँ, ये तो होता ही है, ये तो होता ही था, ये कुछ नहीं है, इससे भी ज़्यादा होता है. अरे तो पहले क्यों नहीं बताया? Why do we have to find out the hard way and then come to you with this, jaundiced eyes thinking you're all doing something wrong? That, the problem, and I've been on the other side, I've been in industry. The problem that we probably have is that we keep talking past each other. At some stage, we've got to sit across the table and have an honest discussion where you tell us your problems, we tell you our problems, and then we find a middle way out. I know it's difficult, but it has to be done. Believe me, and by the way, I have to credit the AIF industry for this. In the last 2 years, I think our relationship with the industry bodies and the AIFs has really improved. We've seen AIFs coming to us samne se and saying, boss, ye problem hai. That what we think, we are doing something out here, we are not sure, it's a bit gray, aap kya bolte ho? I really appreciate that. You're teaching us something, and you're, instead of us being Bollywood police fellows who come in the last scene after the climax is over, at least you're involving us in between somewhere. And we promise to be a lot more indulgent about it when you come and tell us in straightforward terms. And then we'll try and find a way out. So that's one ask that I have. Let's have conversations. Please, when you see something, say something. Don't leave it for us to find out the hard way and then come on you like a ton of bricks. Very quickly, because of this dialogue requirement, please have industry associations which are meaningful. We don't, it doesn't matter who the association is, but just make sure you're represented together, at least 2 or 3 associations, not more than that, which has a wide representation. The problem that we have is, if we have to speak to 1,300 schemes of AIFs, we will never get anything right. I can give you innumerable examples of somebody telling us, do this, we do it, and then some 5 other people coming and saying, ye kyun kiya hai? Ye nahi karna chahiye tha. Get an association together, it doesn't matter who it is. Get an association and talk to us in a concerted fashion so we don't get distracted. So we know exactly what the industry as a whole wants. Finally, in terms of investor education, I think you guys and girls have a huge role to play. You're the experts. You know the ecosystem far better than anybody else. To be fair, many of you, and I see good people out here, I know you're all going out of your way already to doing investor education to say the right things. Keep at it, and encourage all your brethren and your sisters to do the same. It's extremely important for our collective sanity that things like investor education, compliance, regulation should not be left to SEBI alone. It should be the entire ecosystem's challenge. I'm going to stop here. Thank you, and sorry for overshooting my time. And once again, thank you so much, Cafe Mutual, for this opportunity.